Bank failures happen,
Hmm.
and when they happen, whatever your amount is in the bank, you are only sort of insured for 5 lakh rupees
That is
of
right.
that amount.
That is right.
Okay, so in a worst case scenario, then you know your bank, you know where your money is, but you may still not get it. That was the primary thought process behind creating something like a Bitcoin, to say that, boss, your money is your money, your asset is your asset, it is censorship proof.
Who is taking this decision? How many bitcoins are going to be there? Who owns this? Like,
So that's the fantastic piece. His name or their name is Satoshi Nakamoto. He's the inventor.
We don't know who that person
We
is.
don't know. Nobody knows who that person is. Managing those wallets for you, which means the private keys are with them. Ownership and control is with them. Okay?
That's a risk, no?
It's a risk.
Hello, welcome to another episode of This or That. I am Bhartendra Singh. Today we have Mr. Manhar Garegrat. He is country head of Liminal Custody. We have been talking about mutual funds, investments, SIP, Indian markets, international marketing. One thing that I have not covered so far in my podcast is alternate assets. And today we would want to talk about cryptocurrency and the ecosystem and how it works, what are the risks, and understand what is the fundamental behind this asset. So, hello, hi. Thanks for your time today.
Hi, Bhartendra. Thank you so much for having me.
So, I mean, we'll start with basic. Okay, what is cryptocurrency in simple terms, and help us understand these different terms: Bitcoin, Ethereum, stablecoin.
Sure. So, the way I think this can be best explained is to first understand that before the advent of Bitcoin, there was no way that one could actually do a digital money transaction between two parties in the same way that you could do a offline transaction between two parties. What I mean by that is, in an offline cash transaction between two parties, where you are party one, I'm party two. So in the offline transaction, for example, we have this instrument, which is this 500 rupee note. Okay, I hand it over to you. At best, what you will do is try to check the authenticity of this note. You will just look for those marks, etc., and the transaction is settled. Yeah, right? You don't have to bother about this transaction anymore. It's done and dusted. It can be put in the records. It can be filed for taxes. It's been settled in that moment. Timestamp. Everything is done. Okay. Of course, there's no digital record of it. It happened and the transaction is done. As far as both the parties are concerned, matter over. Let's move on. When you try to replicate this same process in the real world, what we've only managed to achieve before Bitcoin was that, okay, मैं आपको 500 रुपए की नोट दे रहा हूँ एंड या 500 रुपए ट्रांसफर कर रहा हूँ अपने बैंक अकाउंट से. You are getting an instruction or an intimation from your bank saying that, yes, I have received 500 rupees. But what's actually happening behind the scenes is that at the end of the day, my bank is working together with your bank to settle it at the end of the day. So the real settlement of the transaction is not yet complete. It's just that the risk of this transaction has been borne or taken by the bank. And of course, then the banks trust each other, because one bank says that, yes, इसके अकाउंट में है 500 रुपए, वो मैं लॉक करके रख दिया हूँ. दूसरा बैंक says, okay, great, हम रात को सेटल कर लेंगे. So they have this trust mechanism. There was no real system where you could actually have, money in the form of a digital token or a digital currency or a digital instrument. Okay, it was simply a instruction that was being relayed to an intermediary through a text file or through some code or some input, and then this instruction was being settled or it was being taken care of by somebody else. In the absence of this somebody else, this transaction could not be complete. Also, there could be some challenges along the way in the settlement if they realize that there are some issues, etc. Now, with Bitcoin, with the advent of Bitcoin, so there has been, people look at Bitcoin as one invention that just happened, but it took decades and decades of a lot of innovations, a lot of research and development to actually come to the final invention and execution of Bitcoin. Okay, so cryptographers, they're called punks. These are people who are really into privacy, really into the concept of self sovereignty, freedom, etc. Those kind of principles to a very large extreme. Okay, and they were constantly trying to research how can we sort of make these payments happen. So interestingly, three different technologies, one is blockchain, the other is cryptography, and the third is known as the consensus mechanism, which was eventually developed. These three big innovations came together to
I
sort
would
of
like you to explain a bit of
all
these
of
three
these
technologies.
all of these. Okay, so we've spoken about Bitcoin, blockchain, we've spoken about cryptography, and we've spoken about consensus. So for now, let's just proceed with this. These three big innovations had to come together. And what did they come together and achieve? They achieved a situation. Okay, and also, before we get into this, we all use computers, we all use mobile devices. At the end of the day, everything that you see in the digital world is based on code.
Hmm.
Code is based on binary,
Hmm.
right? Computer language is ones and zeros. Okay,
Fair.
so that's the digital world. Now anything that goes into the digital world has to play by these rules. Okay, what would happen in a typical digital setup is the moment you have a file, that file can easily be copied and pasted, replicated. Millions of copies can be created, right? That's a basic, because at the end of the day it's simple code, and this code allows us to do that. That's one of the core ways we function in our day-to-day lives. So that was the big problem. How do you take an instrument which is an instrument like cash, how do you transition it into the digital world, and then you ensure that
Ensure
this
there's
digital world, this instrument in the digital form now, because it falls back to ones and zeros and source code, how can it not be replicated? I can print my own money, right? I can just keep going crazy with it. So this was a big problem that these guys were trying to solve. Now coming back to blockchain, cryptography, and the consensus mechanism. So blockchain is a simple database. It's as simple as a SQL database or whatever other databases. The interesting character and feature of this is that, as its name suggests, the data is held together in the form of blocks, and they're all chained to each other. Okay, so there's data set number one linked to data set number two. Number one is data set number two, and then linked to 2 is 3, 3 to 4, so on and so forth. So this is a database in which you can't directly go to what's the data set in number 1. If you have 10 sets, you'll have to unravel 10 to 9. From 10 you'll get into 9, 9 you'll get into 8, 7, so on and so forth, until you get to 1. That's the structure of this database. Okay, so that's one. Second is cryptography. Cryptography is basically all your private keys and your hashes. You input whatever you input in a certain hash, it will always output a certain specific kind of output. It will hash it into a.
So cryptography basically protects the security of this.
So cryptography at the core is encryption and decryption.
It's basically encryption, right?
Okay. So there are messages which you cannot openly display, passwords, important secret messages, or whatever it is. Those or information about your private, public. What is that? PII, a personal identifiable information. You don't want to expose those things, so you encrypt them. You put that information through a hash. It generates a garbled piece of text. This garbled piece of text you and I cannot recognize, but a decryptor can recognize and then extract the information. So it's just simple communications 101. How can we communicate securely? Okay, WhatsApp uses encryption, etc. So that's the other cryptographic innovation. Basically, not innovation. This was already prevalent, but a certain specific standard was adopted, and public-private key pair was sort of brought into this. And the third was how this whole system will run together. Okay, that was the innovation. So with these things, what could now actually happen is there could be a digital instrument which basically would have in a disintermediated cloud, would have an anchor of this file, of this rupee, or not rupee, in this case it would be Bitcoin. This one Bitcoin that I have, think of it as a file, which is a computer file. But unlike a normal file, it has an anchor somewhere in the cloud linked to it, saying that, okay, this, and that anchor in the cloud is linked to one data set on the blockchain. Okay. So if I have to now make a change, remember the blockchain fundamental, I have to keep unraveling all the blocks. Okay. And then get to this data set and then alter or tamper this data set. So this way that chain continues to increase. The more transactions that happen, they keep getting mapped back to the blockchain. And every time my Bitcoin moves, let's say from my wallet to yours, that mapping is being changed on the blockchain. Previously, data set number 1 shows that it was in my wallet. By, let's say, some lot of other transactions have happened on data set 4, I made my transaction of moving this Bitcoin to your wallet. In data set number 4, that transaction will get captured. So this movement of this file is being captured in an immutable manner in this decentralized cloud. Okay. Now let's come to this decentralized cloud. How is this working? Who is managing this? What's happening? Like, it just sounds, decentralization is this key buzzword. So the way it works is, this is all game theory and incentives. Okay. Today, if you look at everything in life, everything is structured around incentives. You have the right incentives, things flow, and whatever we want to achieve, we can easily achieve. So here, I'm going to give you an example of how things work in the traditional manner, in a simplistic way. Okay. Central bank at the core, different banks around the central bank, and then you and I, as transacting customers, have accounts in these different banks. Okay. So think of this as a network with the central bank at the core. That's the origination of this money, rupees, coming into the banks. Through the banks, it's come to us through loans, through whatever. And then when you and I, we transact with each other, typically what's happening is same thing. My bank is talking to your bank, they're settling. So if I give you a check, I'm presenting it to my bank. There's a bank manager there who's sitting, who's checking everything, who's checking if my account actually has that balance. He's checking my signature, he's checking the date, amount, etc., etc. Then he stamps it, processes that transaction, moves it forward, clearance. Okay. Then at the end of the day, finally, when the settlement is happening, is when the ledgers at both the ends are, through a very strict and stringent protocol, ledgers are updated. That's the most sacrosanct thing, right? My account minus whatever 10,000 rupees, your account plus 10,000 rupees. Okay, that's the most critical step in this. And there are these two servers which are being held by your bank and my bank. There are managers, there's electricity, there's all of those set up. Everything is there to sort of make this happen at scale. All fail-proof systems, etc. So this is how a transaction is happening. And if you look at it as a network, then this is how money is moving, through the entire money ecosystem. Now, if you try to take an analogy of this into the Bitcoin space, where you have this cloud, etc., what you have at the center is the Bitcoin core software, along with the blockchain database. And then you have these nodes and miners who are similar to banks. And then you have wallet addresses instead of bank accounts, where you and I actually get into the system and we make transactions. Okay. So the same sort of setup. What happens when so let's assume I have a Bitcoin wallet and I'm blessed, I have 10 Bitcoin. I actually make a transaction of 5 Bitcoin to your wallet. So what happens next? I basically sign my wallet through my private key. That's the encryption, the cryptography. And I say, yes, I am the owner of this wallet and I'm giving you this instruction, transfer 5 Bitcoin to your wallet address. Assign it. The transaction goes and sits in what is known as a memory pool. And there are all the transactions that are happening in real time going into the memory pool. These miners which are there, they act like the bank manager. Okay, they jump into the pool and they're constantly looking for transactions to mine. With simple words, to process the transaction like the bank manager was processing. Now they found our transaction. Okay, so the way it works is, if there are 100 miners wanting to mine our transaction, which miner actually gets the ability to process it, validate it, and then to update the ledgers, the most sacrosanct activity. So now there's a race between the miners. This is all happening in the Bitcoin core, in the software algorithm. If there are 100 miners, it will present to all of them a complex problem. If there are 1,000 miners, it will present an even more complex problem. If there are only 10 miners, it will give a simple problem. Okay, depending on the number of miners active at that point of time. So let's assume there are 100. It gives them a complex problem. The thing with this problem is it cannot be computed directly. It needs to be computed sequentially. So if it's very simplistically x plus 5 equals 10, then you got to go with 0 plus 5, 1 plus 5, 2 plus 5 until you get to 5 plus 5 equals 10, and then solve. So that's where the miners, the mining capabilities, the mining rigs, the big machines, the GPU, the electricity usage, all of this comes into play. The miner with the most amount of GPUs, the most amount of processes running, and the fastest one to get to this answer basically gets the opportunity to now validate and append this transaction onto the blockchain. So one miner got this opportunity. He validated my details, my signature, my wallet address, public key, private key, everything is fine. Now what he does is he updates it on his so he would also be running a node. He updates it on his ledger, basically his copy of the ledger, and he broadcasts it to the rest of the nodes. Today there are about over 17,000 nodes on the Bitcoin network. These are all people like you and me, normal folks who are using their devices. Anyone can download the Bitcoin software today. It's a couple of GBs, and you can start running the Bitcoin core on your machine in your home with a normal internet connection, and you can essentially help run this infrastructure through your machines. So there are 17,000 all spread out. Nobody knows who's the other node, so there's no collusion. It's not concentrated in one country, so it's not therefore they say it's decentralized. It's absolutely neutral. It's not a Russian technology, nor is it a Chinese, nor is it a US or an Indian technology. It's a global technology. So, you're not really worried about the macroeconomic complications there. And so the miner he put it in his node, he updated his ledger. Now this information starts moving to all the other nodes. If more than 51% of the nodes are in consensus that yes, this is the correct transaction, then you and I both get a notification from the system, transaction complete.
How much time does it take?
10 minutes.
10 minutes.
Which is why Bitcoin, though it was started as a peer-to-peer cash replacement, it didn't really pick on as a payment method. You can't,
because it doesn't happen instantly.
It doesn't happen instantly. You can't pay for coffee now and then wait for 10 minutes and then let the payment happen. We don't have that kind of time. But
for a large transaction, you can use it.
For a large transaction, for a cross-border movement, you could use it. For a one-off, large transaction, you could use it. Very well use it.
Before we move forward, I have some basic questions, because you used banks analogy and all of that. So, government tells the RBI to print the money.
Correct.
Okay, and there is
simplicity,
right? I mean, somebody's taking a decision to print this money. Correct. Right? Who is taking this decision? How many bitcoins are going to be there? Who owns this?
So that's the fantastic piece. So the consensus or the Bitcoin core that I spoke about, there are some. So the process that I explained, this entire software is driving that process. It's open source. Coders across the world are open to go and review it. So the best minds in our country have also reviewed the source code. The source code does only 4-5 things, like very few things, but it does them very well, which is all of this that I just explained. Okay. One, there's a hard cap of 21 million bitcoins hard coded into the code.
So 21 billion?
Million.
21 million. Okay.
Million. Also, I've explained that process, but I've not answered one very important question, or one question that can arise. Why are the miners doing all this?
That was the second question.
Yeah. So see, the moment you became the successful miner who's processed the transaction, what happens is that the system now generates new fresh bitcoins. Every successful transaction, system generates fresh bitcoins and deposits them into the wallet of the miner.
of the miner.
The
So
miner.
miner gets some bitcoins.
Miner is the one who gets the freshly minted bitcoins from the source.
Who can become a miner?
So anyone can become a miner. There is no criteria per se. But today, the way the economics have shaped, you will need to have significant investments in mining rigs, in cooling systems. You literally have server farms which are running. So there's a lot of companies, large enterprises who have gotten into this business at an institutional level, and they mine. And there's a bunch of them. All of their information is also.
Can this be done at a smaller scale?
Yes. So there are there are these small devices also that you can. Although what happens is, because it's a race to crack that algorithm, not everyone's able to make it. So if you have a small setup, you will probably not see that kind of success. There will be others who are already doing much more than you. However, the system is also such that there can be, by a stroke of luck, a situation where you may end up actually becoming the miner for a very large transaction, and thereby earn significant amount of bitcoin. So people are playing that casino as well. It's not a feasible model. It's like a shot in the dark. You keep hoping, etc., at a smaller level. But if you do it at an institutionalized level, there's definitely a lot of sense in doing that business, and there's a lot of economics that you can play out, and there's a lot of profit that can be generated.
Let's understand this a bit more. You said there is a limit of 21 million bitcoins.
Correct.
So when it started, there were already 21 million bitcoins.
No. So that's what. So every transaction that happens.
So how many bitcoins are there at this point?
So about 20 million are already.
20 million is
already been mined. Okay. The remaining are going to be mined until the year 2140. They're anticipated to be mined until 2140. Okay. And why is this the case, right? It's been just about 15 odd years, and already 90% of that is gone. And in the last long tail, we're going to see 140 years, kind of 120 years additional. So the way the mining process has been hard coded into that core software is that there is a event called the halving. Okay, every 4 years, the supply of bitcoins that comes into the system reduces by 50%. Mm-hmm. And that keeps reducing until the final bitcoin will be mined.
So who decided there will be 21?
This is the creator of the bitcoin. His name, or their name, is Satoshi Nakamoto. He's the inventor.
We don't know who that person is.
We don't know. Nobody knows who that person is. Apparently, he has a bunch of bitcoins in his wallet, in his holdings. The current consensus is that nobody knows. And that's really the way it was intended to be, because the moment you have a person or a name or somebody in the picture, you can now start attaching intentions behind why this was created. Okay, you can go, if that person happens to be a Russian, then okay, or if that person happens to be somebody else. So this inventor clearly understood that, and therefore the claim is that he walked away from this primarily because it was created on the back of a lot of frustration with the current financial systems. There was the 2008 crisis that happened. There's a lot of over leveraging that happens. There's a lot of inflation that happens, which eventually impacts common people. And this person was very passionate about trying to solve that through the use of technology. And therefore, he has he's remained anonymous, and there is no person attached to Bitcoin. Today, it is become a monster, or a thing of its own.
So who owns this core of?
Nobody owns it. It's open source. Anyone can go and review it. Mm-hmm. Today, there's a bunch of core developers who discuss openly on forums on certain issues. The directions that it will take as a technology software are also decided in a forum, open forum. And then there is voting, there is consensus, there's a lot of all of that. And then the software changes are also sort of decided through that. So it's become a entity of its own. It's this open source code running this software, bringing anonymously 17,000 nodes together, incentivizing them in the right way by giving them the bitcoins. And these bitcoins then are being used by, the more the transaction happens, the more bitcoins come into circulation. There's also a very strong, tight grip on inflation, because it's a deflationary asset. The supply continuously will keep reducing. Therefore, the price increases. In order to counter that, it also goes all the way down to 8 digits. In decimals, you can break it down up to 8 digits. So you can actually have a very minute piece of the Bitcoin and still be able to transact with it, right? So you don't have to necessarily pay 1 Bitcoin, or
You can
you
pay in
can
points.
0.00001 Bitcoin, for example. So that kind of divisibility has been hard coded. The whole inflation mechanics until 2140 have been hard coded. The immutability of the database, how it can be tamper proof. Once you make a Bitcoin transaction, it cannot be reversed. So that's very clear. Then the private key, public key, cryptography makes sure that if you have the private key, then you are the owner. All you need to do is go into the software, create a wallet, by virtue of it get your private key, and then there's no real process to get into this network. It's easy to get in as a wallet holder, easy to get in as a node operator, easy to get in as a miner, easy to get in as a Bitcoin core developer. Everything is open.
Who regulates all this? Like, who is the regulator? I mean, in case something goes wrong with, say, my mutual fund transaction, or there is a non-compliance in my equity transaction, fixed deposit, I can there is a regulator I can go to. There's somebody watching all these players. Who is watching this software, this core of Bitcoin?
So we've gotten used to a post facto world. Okay, because if you look at a transaction between, let's say, you and me, a business transaction, what will we do? We will say, okay, we want to do this transaction, we'll sign a contract, we'll put all the terms on it, okay, and we'll just continue with the transaction. Now, whether the transaction proceeds as expected or not, let's say there's a dispute tomorrow, then we fall back to this contract, then we go into the terms and we see, okay, now, and then we go into the recourse mechanisms. All of this, if you realize, are post facto. Okay, if I create a password and I forgot it, then okay, I need to go and request for a password reset and all. These are all post facto. We live in that kind of a world, and we're used to that kind of a setup because people need a lot of hand holding, etc. This brings a very different paradigm. Bitcoin, blockchain, cryptography, all of these things. They say that you come here, you be prepared. You take your contractual obligations, you take everything. You agree with them, you accept them, and then you sort of code it into the system. Then you participate in this system. Once you've done this work beforehand, there is no chance of a dispute or whatever happening, because the system does not allow that to happen. System is very, very clear on math and code. If you and I have agreed to something, that gets coded. For example, let's say we will only make this transaction when USD INR touches 95 rupees on this RBI feed. I take the RBI feed and I plug it in, create this contract, and then you and I both don't have to worry. The code takes care of the actual execution as per the agreed terms. Okay, so this basically brings the entire thought process into a pre-facto. You prepare, you plan, you do everything in that way. Okay, so coming back to your original question, in the Bitcoin world, you can be a participant as a wallet holder, as a node operator, as a miner, as a whatever. All the rules of the game are clearly laid out there. You look at the rules of the game. The rules of the game say that once a transaction happens, it cannot be reversed. Once you lose your private key, anyone else who has access to it can access your wallet, take your funds away. So these responsibilities fall flat on the participant. Are we ready for taking those responsibilities? Are we used to a world where I am responsible for what's happening in my bank? I think we're not. I mean, that's a different challenge. But those who are able to are operating absolutely fine without any challenges. And literally, a world of finance is being built on this, where large institutions, banks, everyone's coming into the picture. And then, of course, this is one extreme, this is the other extreme. We are also moving towards a world which is a good mix of both of these value systems, and we're seeing that also happen.
So what is the risk? Like, I mean, this is basically a software, right?
So this is a software. This is
It's technically a software,
Yes.
and you're saying we don't know who owns it. And
So think of an open source software that you may have used, or anybody uses in their applications. A lot of open source software has allowed these mobile apps to flourish today. The apps that we see, right? Uber uses a bunch of open source. We at CoinDCX we used to use a bunch of source. At Liminal we're using so many open source softwares which have been created by developers across the world and then uploaded on these platforms, right? So that's how it is. Eventually, the best part about open source is that because it's open and public and criticizable, reviewable by so many people, people can go and add value to it. People can go and criticize it. It gets shaped into a gold standard, which is the global gold standard. Nobody's stopping anyone from going there and suggesting. So for example, if you feel very strongly about, there has to be one person who is nothing stops you from going and making that from making a case around this, and then making it into a very solid argument, a logical argument of how it can further the Bitcoin ecosystem, how it can really help the ecosystem. And if you're able to gather a lot of consensus around it, if your logic actually has a lot of sound sense, it may probably get taken in. So it's become a community thing that's driving in, and that's really truly the beauty of it.
It might be a naive question, but let's try to understand it this way. So whatever I'm giving to my bank, or whatever transaction that let's say I deposit XYZ rupees in my bank account.
Correct.
Banks hold it in terms of in the whatever note or whatever in their software, in their server. I know where it is. It's SDFC.
Correct.
Here I don't know, right? So where is it? Like, where are these servers?
So I'll give you a very interesting scenario. Now, in our India context, touchwood, our systems are fairly robust. Our institutions are also doing a great job. We've never thought of this, but bank failures happen. And when they happen, whatever your amount is in the bank, you are only sort of insured for 5 lakh rupees
that
amount.
That is right.
Okay. So in a worst case scenario, then your bank, where your money is, but you may still not get it. Now, we don't see these black swan scenarios in India. We've seen a few. Government steps in, taxpayers' money comes in. We are a big economy. We absorb those losses and we move on, right? But reality is that that's not your money. In a certain situation, it could be taken away from you, with the exception of, let's say, that 5 lakh rupees. That also you may have to go through a lot of hoops to actually get your money back. So that was the primary thought process behind creating something like a Bitcoin, to say that, boss, your money is your money. Your asset is your asset. It is censorship proof. Nobody can come and take it away from you under any circumstances, unless you screw up yourself, unless you are not careful with your private key, unless you log into malicious systems, or unless you allow entry into your access control mechanism to someone, etc. So
there might be some risk still associated with
lots of risks.
So what are those risks with holding Bitcoin?
So see, the fundamental risk with Bitcoin, digital assets, all of them, Ethereum, etc., is that they're digital files, but these are the only digital files on the internet that truly carry value. Okay. You can steal photographs in compromising positions. Okay. You don't get value out of it. You can arm twist me and blackmail me and say, boss, if you don't give me value money, I will broadcast this. Okay. So you got the digital file, but you didn't get the value. If I have Bitcoin and you are able to access my Bitcoin, you got the value. You don't even need to look at my face again. Take the money and go. Enjoy, blow it. Transaction settled. Right? So that's the biggest difference in cybersecurity risk for any other paradigm. In a banking situation, for example, there could be many recourses. There could be some freezing, because the settlement has to happen at the end of the day. The banks can coordinate. There is some time, there's some cooling off period. So a lot of things can be put into place in that kind of a scenario. Still, we see a huge number of those cases on UPI frauds, right? People just basically sending random things, and we've seen.
So similar frauds can happen here also, right?
Yes, absolutely.
So let's understand. Like, so let's say I have 5 bitcoins. Where is it? It's in my wallet. What is this wallet? Where is this wallet? How do I hold my
so you don't necessarily hold it. It's in that software code.
Fine.
That software code created a public key and private key pair.
Okay,
which is like bank account and password.
So technically, nobody owns it. There is a Bitcoin associated with a public key and a private key. Whoever has this key has this. It's as simple as it. So there is no ownership as such. Whoever.
So all the mined Bitcoins are, let's say, in this cloud. Okay. Which one of them is yours? That is given to you, or it is mapped to that public key. Right? That public key comes with a private key.
It is not to a person. It is to a public key which comes with a private key. Whoever has this has the ownership control. He can sell it.
You can transfer it. So again, see, sell it is.
Transfer it, not sell it.
The only thing that you can do is move it from your address.
Sell it is the incorrect
to
thing.
another
I can
address.
transfer it.
Yes.
I can transfer it. I can buy something from it.
Yeah. So again,
I can do a transaction. It's a transfer only, basically. I can just transfer it.
You can transfer it for or not for a consideration, basically.
Okay.
If you transfer it for a consideration, it's a.
So for the Bitcoin, there is a public key and a private key. It's there in a wallet with me, or like
you access this
through a wallet.
And
who has this wallet? Like
these again, hundreds of developers have jumped in and they've created these wallet systems. You can also go and create one. It's all open source. So you use the primitives of this public key and private key cryptography, and you interact with the blockchain to generate the private key and the public key, and therefore now it becomes your wallet. So if I created, let's say, Manhar wallet tomorrow, I would simply be going into this public infrastructure that you could also be going to, but I'm the one who's managing the distribution. I'm onboarding you. I'm giving you a nice slick UI, and whatever transactions you create on this being routed back to the blockchain through my wallet. So there are a lot of these wallet apps available. Anybody can create these wallet apps on Bitcoin, Ethereum, etc. And you can download any of those. There are different types of wallets. There could be a simple mobile wallet as a software. There could be a hardware, a cold wallet that you actually, which has a private key, like a digital signing signature, DSC, digital signing certificate, the pen drive that comes. Similarly, you have this pen drive with some buttons and some screens, which have the private key inside. You could basically hold your private key within that wallet. So one could say, okay, my Bitcoin is on this wallet. Yeah.
So in my traditional finance, I have a private player. Here you're saying everything is open source, right? So where do all these players come in? Exchanges and the custody, and how do they come in place?
Absolutely, that's a very good question. So system is open for everyone, but how many have actually been able to go understand it, decipher it, and because it's complex, it's made for a typical nerd kind of a person who really understands everything about these primitives. So now how do we get more and more people to participate in this? That's where all these abstraction, I call them the abstraction layers. An exchange is what? At the end of the day, you want to buy Bitcoin. You could potentially go into all these wallets got created, everything got created. And by the way, this whole ledger is public.
Yes.
Okay, so you can go and see actually which wallets have balances, etc. People started thinking, what if I could get all these wallet holders together and allow them to transact within each other? So here I've created a layer now where I've said, if you have Bitcoin, bring your wallet, come to my application, and I will help you find buyers, sellers for Bitcoin. So that is basically in some ways an exchange.
Okay, so it's a private exchange. I can today, if I understand the system, I can create an exchange which will have multiple wallets, and these wallet holders can do the transaction. That what?
So that is one very, very basic thing which started in the beginning that was basically peer-to-peer trading. So it was more like a board where you bring in your assets. Whoever wants to buy it gets listed. Somebody else picks that up, says, and then they get connected and they transact with each other. Today we are at a very advanced stage. So when I say an exchange, there's a bunch of other things that you're doing. You're bringing in liquidity. You're creating markets. This is just one set of wallet holders on the Bitcoin network. Now imagine similar set of wallet holders on Ethereum, Solana, hundreds of tokens, bringing all of them together, then creating these markets. Then the most important thing in this is not everyone comes with a wallet and Bitcoin and wants to trade. What about the person who's wanting to start for the first time? He's starting with INR, dollar, or his native currency. He wants to get into the market and interact with people who may have Bitcoin through a fiat to crypto transaction. We call this fiat to crypto. And if that is the case, then the exchanges come in, they facilitate that. They bring in people who are bringing in a lot of INR. Let's say in the India context, all these people, they bring in, they deposit INR, they handle the INR properly, they take it into their own bank accounts. Through those INR, they will enable other buyers who are bringing in different assets. Then they'll build those markets, they'll ensure the markets have liquidity. It cannot be the case that you're putting in an order to buy one Bitcoin today and it's getting settled after 3 days. There is no seller. You need to make that market happen. You need to get the liquidity in place. Then that's happening. You need to today do a lot of compliance related items. You need to do TDS filing. You need to do a bunch of other things. You need to have all of this taken care of in a cybersecurity, secure kind of a setup. So all of those things is what an exchange is doing. It is your bridge into that decentralized world, but with all the taking care of all the modern, your traditional world requirements that you have. And from the traditional world, which is INR, you move into the digital asset world.
Let's understand it more simply. Today, I say, okay, this seems interesting to me. I have 1 lakh rupees.
Yes.
I want to buy some Bitcoins.
Yes.
What are the options do I have?
So, see, in the India context today, the best option is to go with an FIU registered exchange.
Okay.
Most of the exchanges.
What is FIU?
FIU is a Financial Intelligence Unit. Okay. They are basically today they are the primary governing body for crypto exchanges.
Okay.
You cannot operate in India as a these are known as VDASPs. Okay? Bear with me. Virtual Digital Asset Service Providers.
Okay.
So today these exchanges, custodians, all of us operating businesses in this digital asset realm, globally, we have a definition for us. We are called VDA service providers. Okay. There are global rules created by agencies like FATF, which is Financial Action Task Force, to combat terrorist financing, money laundering. And those rules apply to all VDASPs.
Okay.
We are also VDASPs and recognized by these bodies globally through FIU in India. FIU is our sort of hub for that. The idea with
FIU again is a private entity, or it's like
a government.
It's a government entity.
Yes, it comes under the Ministry of Finance.
Okay.
And they are not a body only for the VDA industry. They take care of the gold industry. They take care of payments, banks. All of them have to register with FIU. All of them have to have a reporting into FIU, because wherever transactions happen, those transactions could be for illicit purposes. So the idea is to, whenever there's a suspicious transaction happening on your platform, your responsibility is to inform the FIU.
So FIU will have so an exchange has to register with FIU.
Exchange in India.
So one is exchange.
SP, yeah.
What else?
Custodian.
Custodian. Explain me the difference between a custodian and exchange. Like you are a custodian, right? So what is the difference?
So again, in the traditional finance, you have Bombay Stock Exchange, National Stock Exchange. You have Zerodha, Grow, Upstocks, etc. And then you have NSDL, CDSL.
Fair.
Okay. And there's a simple principle called segregation of duties. You cannot have an exchange whose primary job is to connect buyers and sellers, to actually know who the buyers and sellers are. Because if they know who the buyers and sellers are, they could यार तू मेरा दोस्त है चल तेरा transaction पहले. That risk is there. Therefore, the client relationship is given to a broker. Broker knows who is the KYC person, etc., etc. Broker simply takes the transaction from the end user, routes it to the exchange. Okay, exchange is doing one simple job, and it's doing it absolutely well. All the liquidity. There were, if you know, there were many exchanges across India. And the way liquidity moves it concentrates into one or two. Today we only have National Stock Exchange, Bombay Stock Exchange. So they just route it there. They hold the customer relationships. So therefore, they do not get the execution of the trades. At the same time, neither the exchange nor the broker actually holds the securities. Securities are held by NSDL, CDSL, because the broker could essentially be using those securities for margin trades, for leverage, for whatever with other clients, right? That cannot happen. Only when a user specifically outlines, I want to use my security as margin, NSDL takes cognizance of that, and there is an arrangement where that is provided to him through the broker, etc. Or eventually settlements and transfer of ownership is all controlled by NSDL. Nothing can go wrong there. So this segregation of duties creates a very sort of robust, risk-managed ecosystem, compliant ecosystem. Similarly, in the digital asset space, what has happened is that exchanges basically became the everything for the participants. They became the exchanges themselves. They became the brokers, so to say, the people who were handling the relationships, and they're also the custodians today. So as it stands, all of these three duties are being performed by an exchange collectively, which then presents a lot of different kinds of risks. Okay, so what we are seeing globally, wherever regulatory frameworks are developing, even in countries like Indonesia, is that the regulators are also going back to all the learnings we've had from the traditional space and incorporating those principles into the VDA space. And today there are licenses for custodians. And if you go to a regulated jurisdiction like Dubai, under the VARA, which is Virtual Assets Regulatory Authority, they very clearly lay out the rules that if you are an exchange, you cannot operate by holding the custody of the user assets. You have to work with a third-party custodian who's also regulated and licensed under VARA. Okay, so the same what we've seen in traditional finance is playing out in digital finance, and that's where we come in as infrastructure builders, or as people who can actually create the mechanisms to just safely store and secure digital assets to ensure that the overall risk in the ecosystem reduces dramatically. So that's the key difference. In the India context, we are yet to see this play out. We have not seen that segregation. Hopefully, once there's a regulatory framework that is being put into place, these discussions will also come into picture.
So I can't directly obviously go to a custody. So today, again, like at the cost of repetition, you want to take a break?
No, that's fine.
That's fine. So at the cost of repetition, what I want to understand, like I want to invest today. You've given a very good analogy. People understand this. I go to a broker will facilitate it through a trading account. Transaction will happen through exchange, and then I'll go and deposit my securities will get deposited with NSDL and CDSL.
Correct.
Now just take this analogy and say, today if I do this 1 lakh rupees of transaction, where do I go first of all? Who is the equivalent of a broker today in India?
So today in India, everything can be done through a single exchange account.
Okay.
You just go to an exchange.
So exchange is kind of a broker for me here.
So it doesn't matter. Because,
it doesn't matter. I'm directly going to the exchange.
They're all fused together.
Okay.
They are the broker. They are the exchanges.
So I go to an exchange.
You just go to a FIU registered exchange in India. One of the better known ones. And there are quite a few good ones. We've got good founders doing good work there. Go to one of them and create an account.
When you say create an account, what gets created? It's like in case
this is a proper normal account.
Normal account.
Sign up
Sign
email
up.
ID,
Okay.
password,
Okay.
2FA, you do all of that. This is now you are in the Web 2 world, as we call it.
Okay.
We have still not gone to the blockchain,
Hmm.
and you will not have to bother about the blockchain also once you get into this kind of environment. They will create accounts for you. They will create all your wallet addresses for you. They
Okay.
will
So
create,
when they create an account, they will create a wallet address for me as well.
yeah, they will create. I mean, sequence and chronology may, they may not do it right at the time, but
I mean, they
eventually
create.
what they're doing is they're creating your Bitcoin wallet, Ethereum wallet, all the assets that you may invest in. They're creating those wallets and managing those wallets for you, which means the private keys are with them. Ownership and control is with them. Okay?
That's a risk, no?
It's a risk.
It's a risk.
Which is why globally regulations and regulatory frameworks are insisting that it should not be with them. It should be with specialized custodians, third-party custodians,
Which is where you will.
which is what Liminal does. So so you open an account, they create all your wallet addresses for you. They give you a bank account or a virtual account which is dedicated to you. You drop INR into that account. Now they credit that balance to you. Let's say you put 1 lakh rupees. It show you the 1 lakh credit on your account. Against this 1 lakh, you can place orders for whichever crypto you want. Okay, the markets are constantly moving. This is a 24/7 market. They've put in all the efforts to create the liquidity and to ensure market making is done. All of that is done. So that whenever you want, you can place an order and it will get fulfilled in the least amount of time with the minimum slippage.
How do they earn? They take some
earn
commission.
brokerage.
They earn brokerage, just
Very
like a broker.
Very
Straightforward brokerage.
Yeah. That is all clear. You place your order gets executed. They make sure that the seller gets the asset because the asset rests with them. Right? If you bought Bitcoin, they'll just credit it to your wallet. Your balance from INR will move into Bitcoin balance, and the person who sold it will basically get the INR. He's now open to withdraw it back into his bank account from the exchanges.
So let's say I get some Bitcoin and let's say some price increase or let's say some decrease and I want to sell it now. So they will facilitate the sale and they will immediately.
And God bless these Indian exchanges. I think they are, in my experience as an investor, the fastest in giving, as the good ones, in giving you the INR withdrawals from across any other product. I recently needed money, and of course, I've had investments in traditional instruments also. All of them take a bunch of time, for settlements to happen. This is instant. This is like you sell your Bitcoin, you just say withdraw, and the very next second you get an SMS credited.
How does the taxation work on this?
So there is a 1% TDS on every sale. So every time you sell, 1% is deducted, and then
so it's an exchange's responsibility to deduct.
So it's not exactly, but
they do.
Indian exchanges are all doing it. They're going out of their way to make sure that the user doesn't have to bother about all of this. Then there is, of course, the 30% flat tax. If you've made any gains on crypto, you have to pay a 30%.
You have to declare it, or government can find it.
TDS.
I mean, the gains that you make.
TDS. Selling price.
Okay, fine.
1% TDS. So they already have your data. And today in your filing systems, you have a special section for VDAs. You have companies, like CoinX, who are actually providing you the ability to compute your taxes. So all of that is brilliant in this ecosystem. With a very short span of time, they've just made it so super easy. And with one click you just do all your taxation, etc. 30% flat tax on gains, no offset on losses. That's a very big pain if you know, but it is what it is. And I think there are other ways that you can also be lending or earning interest in crypto terms. So you lend 1 Bitcoin, you earn 0.00 1 Bitcoin on that over time, right? So that 0.001 Bitcoin also gets taxed at realization at 30% income, etc. So all of those things are there, and everything is beautifully set up today. So all a investor needs to do is just go to one of these platforms. So there are also platforms, some other questions that investors have is, which asset should I invest in? Okay, I created an account. What next? What do I buy? Where am I? So there are businesses, there are companies who are, who've got the best indexes in the world on crypto, Bloomberg index, and that index is managed by these analysts who are constantly looking at tons of data, and who are creating the allocations of the top 20 cryptocurrencies or virtual digital assets in which you need to have investments in, which are going to go big, etc. And they offer that index to you in a simple form. So companies like BitSave, you can just simply go sign up with them, put in your INR, deposit your INR, and invest in that index. And that index is now managed actively by them. They take care of all the rebalancing, etc. So very similar to the way our current financial systems have been built in the traditional space. You have a lot of that in digital assets as well. Very easy, all Web 2, all very similar to our traditional setup, with the highest possible compliances that are there in the country today. There's no framework, regulatory framework, but bunch of it is there. And this is all available today for average investors.